Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. As the Russian tanks rolled into Ukraine, they not only set in motion a war, but also an economic upheaval across Asia. Most Asian countries are now bracing for a tough and uncertain time ahead. Our next report offers a peek into the likely troubles that this war might cause to these nations, including India.
Asian stock markets rebounded on Friday after seeing a sharp fall the previous day when Russian President Vladimir Putin launched a military invasion of Ukraine. Even as uncertainty continues over how this crisis will unfold, crude oil prices crossed $100 a barrel. Analysts at Nomura in a recent report said that a sustained rise in oil and food prices would have adverse impact on Asia's economies, but with varying effects. Global food prices have surged as the Russia-Ukraine conflict threatens to disrupt the supply of wheat and corn. The two countries account for 29% of global wheat exports and 19% of corn exports. They also contribute 80% of the world's sunflower oil exports. The impact on Asia in the form of higher inflation, weaker current account and fiscal balances, and a squeeze on economic growth will be felt mostly through commodities, especially food and fuel. India, Thailand and the Philippines stand to lose the most, while Indonesia would be a relative beneficiary, Nomura says. The negative impact on Asia is predominantly because most economies are net oil importers, and food and energy accounts for nearly half of the consumption expenditure in emerging market Asia. Every 10% rise in oil prices will drag down India's GDP growth by 0.2 percentage points, while Philippines and Thailand will see a hit of 0.1 percentage points. There is also a risk to corporate profit margins, as the entire input cost burden is unlikely to be passed on to consumers. The Indian rupee and the Philippine peso are likely to depreciate the most with wider trade deficits. In India, Nomura expects higher oil prices to increase the risk that retail inflation breaches the upper band of the RBI's 2 to 6% range, weigh on fiscal finances if excise duties are cut again, weaken consumption demand, and push the basic balance of payments deeper into deficit. In Thailand, CPI inflation is highly sensitive to oil prices. The cost of living crisis risks weakening consumption. A slow recovery in tourism adds more downside risks to current account deficit. The Philippines is one of the most vulnerable economies to higher energy and food prices. Nomura sees risks of a much wider current account deficit in that country due to its high oil import dependence and immediate pass-through to customers, and also due to the absence of subsidies. However, Indonesia will be an outlier. Even though it is a net oil importer, it benefits from rising prices of palm oil, LNG, and coal. The impact of higher oil prices would likely be fully offset by surging prices of non-oil commodities, resulting in a net neutral impact on the current account deficit. According to Nomura analysts, most Asian consumers have not yet fully recovered from the pandemic and have lower savings. Therefore, higher inflation can squeeze real disposable incomes and weaken the incipient consumption recovery, and the impact could fall disproportionately on lower income households.
Troubles for Asian economies are aplenty. Add to that the burden of higher energy prices for importers like India. Commodity prices skyrocketed last week after sanctions were imposed on Russia. Brent crude surpassed $100 a barrel for the first time since 2014, while aluminium prices touched lifetime highs. Gold prices also rose to a 13-month high as investors rushed to safe haven bets. Will this rally continue this week, or will equities be back in flavor? Our next report takes a deep dive. As the world saw one of the worst conflicts unfold in Eastern Europe last week, investors turned to commodity markets to hedge against the growing uncertainty. Moscow's invasion against neighboring Ukraine stunned the markets, with investors selling first and asking questions later. While equities crumbled, crude oil futures topped $100 a barrel mark and gold spot prices breached $1,900 per ounce last Thursday. Aluminum prices too reached all-time highs, while nickel prices are approaching decadal highs. Analysts say this could be just the start of a rally in oil prices, and investors and companies should brace for higher commodity prices over the next few weeks. According to Vandana Hari, founder of Vanda Insights, the worst-case scenario is unfolding. Crude's rally may have only just begun, as the full impact on global oil and gas supplies is yet to be seen and factored in. The door to a diplomatic de-escalation is not firmly shut, but it will take some major efforts to kick it open again. Should the Kremlin decide to cut off gas exports to Europe, all the world's gas producers put together do not have the spare capacity to plug the gap. To put things in perspective, Russia exports about 5 million barrels per day of crude oil, more than half of which goes to Europe and 42% to Asia. As regards natural gas, Russia has the largest reserves of natural gas in the world, but is the second largest annual producer of natural gas after the US. Given all this, the current geopolitical tensions in Eastern Europe may drive commodity prices further up in near future, flaring inflationary pressure. If the standoff between the two countries diffuses and the sanctions stay limited, the economic impact may be limited. Let's go to Sugandha Sachdeva, Vice President Commodity and Currency Research at Religare Broking, to know how the commodities market may play out this week.
This week, commodity prices are likely to witness significant volatility given the geopolitical developments surrounding the Russia-Ukraine crisis. As for the crude oil prices, Russia's invasion of Ukraine is actually driving a lot of global supply concerns in an already tight market. And investors are also bracing for the potential impact of trade sanctions on Russia, which is the third largest crude exporter globally. Last week, we have seen that Brent crude prices have tested levels of close to $105 per barrel, which is the highest level since 2014, before we saw some correction setting in prices. This week, again, we feel that prices are likely to remain underpinned and we are likely to witness buying interest all over again, even though we feel that prices will remain capped at levels of $110 per barrel for Brent crude, while for WTI crude, we are looking at levels of $105 per barrel. At those levels, we feel that correction is again likely to set in, as US has indicated that it might look at releasing strategic oil stockpiles to address soaring prices. Besides, on markets radar would be talks between US and Iran, and in case there is any lifting of sanctions on Iranian oil sales, that can actually increase global supply by around 1 million barrels per day. So that will actually cool off the sentiments in the market, and that can lead to some correction setting in for oil prices. Apart from that, the focus would also be on OPEC meeting and their production policy, and that would also steer oil price movement going ahead. So in terms of the overall levels, we feel that Brent crude prices are likely to remain supported at levels of $92 per barrel, while for WTI crude, we feel that prices will remain supported at levels of $89 per barrel. And on the higher side, 105 and 110 per barrel are the levels to look for. As of now, inflation has been soaring higher because of the rising commodity prices and the supply side bottlenecks. So that is likely to keep gold prices underpinned. As for the levels, we feel that $18.80 per ounce is likely to act as a very strong floor for prices in the international markets, while in the domestic markets, 50,000 mark is likely to provide a strong floor for prices and can again lead to a lot of buying interest coming in prices. However, on the higher side, 1965 per ounce is a strong hurdle area for prices, and for the domestic markets, 52,500 is likely to act as a very strong resistance. Unless these levels are breached on a closing basis, further upside is not likely in the immediate short term.
For silver, Sugandha expects the metal to find support at 62,500 rupees and resistance at 69,500 rupees. Coming to equities, the holiday truncated week may remain volatile with global factors acting as the key market triggers. Domestically, auto sales data, services and manufacturing PMI data, quarterly GDP print, and SEBI's new T+1 settlement cycle may also affect trading sentiment.
The trend is down now. So, if market rallies, people who are stuck up will try to exit. Because in last 2 years, almost 100% increase in the new investors, and they have not seen this kind of market. Whenever they bought, they have seen profit. But in the last 3-4 months, they are sitting in loss. And the last 2 days fall, their M2M payment was very high. So there are a lot of messages on the social media that I have to sell my kidney and average my stock. So that is the pressure they have because of the new margin rules which SEBI had a few months back. So now they have to pay upfront money to average. Even if there is a shortfall, then they have to recoup. So I think the volatility will continue and the bias will be downward.
After the war, economic upheaval and the market dynamics in their wake, let's now move on to a company which has been seeing a stable growth for long. In an interview with Business Standard's Surajit Das Gupta, Chairman and Managing Director of Bajaj Finserv, Sanjiv Bajaj, tells about how he plans to take this financial service business digital. Let's listen in to the interview.
From a auto finance company to one of the largest NBFCs, it's been a long journey. If you could briefly say now what's next for the next 2-3 years for you?
The journey of Bajaj Finance over the last 14 years, it has been about systematically adding new products every couple of years, about building geographical capability. Initially, the first 50 cities, then the next 500 cities. Today, we are now in over 3,000 cities and towns around the country. And across these geographies or products, our focus continues to be to use data, to use analytics, to understand more and more about the customers. What is the risk of the customer versus our own risk appetite? Now, when I look at the next 5 years, this world is going digital. Many businesses like us have not only a very significant digital opportunity, but if we don't get it right, we will have new players come in that will threaten what we are doing. The pandemic, in a way, enabled us to reset what we were doing, reorganize our thoughts, and create a new strategy for the digital world. And over the last 2 years, that's what Bajaj Finance has now been focusing on implementing. And our new app, what internally we call our 3-in-1 app, puts the customer right in front for a frictionless experience across our multiple products and services, and not only products that we make, like our loan products, but also investment products that we sell for others, payment products, and also protection products like insurance. So it is about creating that next generation experience for customers, but it is also about creating it for partners. And finally, it is also about taking our employee engagement to the next level of integration. How can we make their work life easier, more productive? How can we make learning and training more seamless? A lot of it is self-learned. How can we make it more intuitive?
What would be the size in terms of the customer base which you will really have once you do this?
Currently in Bajaj Finance, we have 50 million plus active customers that are credit tested, that are credit approved for multiple products. Almost half of these are digitally working with us to buy different products. And we are working with the other half as well to enable them to do that. Typically, if you see the 100,000 stores that we have over the coming years, each of these stores will interact with us end-to-end digitally. If you look at the number of partners that we have on our debt management side, on the collection side, we've again built a software for them so that as they interact with customers, it is done with a high level of compliance It is done with the right information to the right customer so that the whole experience is as frictionless again as possible. So entire debt management services over the next year and a half will also go digital. So will our employees engage. So it is not that it's going to be a percentage of our business. By and large, our entire business in the coming years will be digitally enabled.
So you said you'll have 50 million customers to begin with. Say in the next 4 or 5 years, what is the kind of numbers that you're looking at?
In a 5-year period, there should be no reason why we should not be at 150, 200 million customers who we actively work with. Another important area for us is payments. And currently we have a number of initiatives. We have a prepaid license. Our own payment gateway will be implemented over the next year or so. And what payments does is payments ends up becoming a very strong transactional glue for customers. Because, every day we are using now, whether it's Google Pay, whether it is XYZ Pay, and tomorrow we will use Bajaj Pay. And we will use that in the same way, whether you want to buy groceries, whether you're paying your restaurant bill, whether you're ordering something online. So the engagement is very high on a transaction basis using payment. But a payment platform by itself doesn't necessarily make much money. So for somebody like us that already manufactures and sells loans, distributes insurance, investment products, where we make money in Bajaj Finance, adding payment becomes a natural extension to create that glue for the customer. But yet we then cross-sell them our products and solutions where we make money. Why should somebody like us get this 150, 200 million customers in the next 5 years? It would be one, using payments as a transaction glue. The second is on the investment side. So today, whether it's fixed deposits, whether it's mutual funds, whether it is other financial instruments, as we start selling more and more of these to the existing customers, it becomes a relationship glue. And then when you sell them your core products, whether that's a loan or insurance product, then you add the next glue, which is in our case, the business glue.
You have got into the whole mutual fund space, and you have also done a lot of innovation in the health.
The mutual fund space is a very new space for us. We actually first applied for a license in 2011 when we got an in-principle license. But when we looked at the space, and even at that time it was quite crowded, we were very clear that we didn't want to be a Me Too. Now, with the very large number of customers that we have, we believe that we can create a set of unique offerings by looking at different customer segments, by not doing just a one-size-fit-all product, by looking at much lower costs than what the traditional industry is used to. And this is by leveraging technology, leveraging the digital space, which has evolved quite a bit in the last decade as well. The health solutions is a very interesting space. We've been doing loans to doctors, to individuals, to patients for their medical requirements for many years. We've also been insuring them. Health insurance has been a very significant business for us, due to which we have our network of clinics, of hospitals around the country. And about 3 years ago, one day we said that, let's look at this problem from the customer's point of view. We realized how disorganized this entire sector was. We said, why don't we digitally organize this and create a health solutions platform, which we have launched, which is called Bajaj Finserv Health. On this platform, we are aggregating. So now in over 200 cities, we have aggregated almost 100,000 doctors, 1,000, 1,100 hospitals. We want to take it to 5,000 hospitals. We are aggregating pharmacies. We are putting together clinics, laboratories, and we are creating health solutions for a customer with loans and insurance built in. We've also created a patient management software for doctors, and over 10,000 doctors have implemented it, where patients' health records will be stored with patients' approval. Their prescriptions will be stored. Teleconsultation is available. We are doing now nearly 100,000 appointments a month, out of which more than half are teleconsultations. And all this data becomes available to us so that over a period of time, we can create customizable outcomes. So the whole idea is to create customizable, personalized, preventive and prepaid outcomes for individuals. And that's what makes this a very interesting business.
Coming back to your father, he was always considered to be the auto man of India, but one didn't see him a lot of articulation about the finance business. So did he give you any advice on this and what to do? Or he said, no, you look after it. This is not my business.
He had this uncanny ability to focus both on the big picture at 30,000 feet and grasp what the issue was, and simultaneously dive into the smallest of detail where he would tell you where you haven't crossed city or dotted an I. And while he wasn't an expert in the financial services business, but in all our reviews with my father, my team members used to come back energized and initially even surprised at how he had the ability to pick up the relevant questions and ask them that. So they had to be on their toes. They had to be prepared. Personal anecdote for me was, I think it was between 2006-07, when we were significantly evaluating demerging the financial services business. And as you know, my older brother Rajiv was firmly in the seat driving Bajaj Auto to newer heights. And I volunteered. I said that, let me move on to the financial services business. And after dinner, because we stayed together, we used to very often just stroll for a bit. And he was very candid. So he told me, he said that, so far, you were sitting in the back seat in Bajaj Auto. So while none of the credit came to you, neither did any of the blame or any of the failures come to you. If you go to the financial services side, and this is something that's very new, but given your MBA, given your experience of the last decade in Bajaj Auto, he said, there's no reason why you should not be able to build this business up. But keep in mind that success and failure will be both on your watch. And I told him right away, I said, this is what I want to do. And he told me, he said, I can't be more proud, because I hope that would be your answer. But as a father, and of course, as a chairman of the group and the businesses, I had to put the risks out in front of you as well. So as he was with anybody else, he was always very direct on what the opportunities, the risks were. But to me, he was always very, very supportive.
Thank you. Wonderful talking to you, Sanjiv, as usual.
Likewise.
Last week, as the Russia-Ukraine conflict escalated, India launched an evacuation exercise to bring home its citizens stuck in the conflict zone. An Air India plane under the Vande Bharat mission evacuated about 240 Indians before the Ukrainian airspace was shut for air traffic. Our next report tells us more about the Vande Bharat mission.
On February 18th, Air India announced that it would operate 3 flights between India and Ukraine on 22nd, 24th and 26th under the Vande Bharat mission to help Indian citizens fly back home. The second special Air India flight turned back mid-air in the morning hours of February 24th after Ukraine closed its airspace due to Russian invasion. While the government is devising alternate plans to evacuate Indians stranded in Ukraine, let us take a look at the Vande Bharat mission. Immediately after the outbreak of coronavirus in 2020, India's aviation regulator, the Directorate General of Civil Aviation, had suspended all commercial international flights in March of that year. This restriction has been extended till February 28, 2022. Most of the other countries had also suspended flights to check the disease. However, a large number of requests were received from Indian nationals abroad for repatriation. In response, the government had commenced operation under the Vande Bharat mission on May 7, 2020 to facilitate return of stranded Indian nationals abroad in a phased manner. The Vande Bharat mission is considered one of the largest civilian repatriation exercises by any country in recent history. Although Air India exclusively operated the flights, the mission was soon extended to private carriers from the 4th phase. During the pandemic, the mission also facilitated travel of passengers between India and various parts of the world. The operations under Vande Bharat mission were commercial operations by the airlines and airfares were paid by passengers. The center has not provided any subsidy or grant for the mission. 84 flights were operated in the first phase that lasted 11 days till May 17th of 2020. The mission is currently in its 16th phase. As of 31st October 2021, more than 2.17 lakh flights have been operated under Vande Bharat mission, and over 1.83 crore passengers have been facilitated.
More than 9.5 million passengers have returned to India from over 100 countries, and over 8.8 million have flown to foreign countries from here under the Vande Bharat mission. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.